Good afternoon, everyone, and welcome to another Tuesday afternoon Barometer Readings webcast. I'm Pamela Hastings, Relationship Manager at Barometer Capital. And today we will, as always, be joined by our Chief Investment Strategist and President, David Burrows. David comes back off of a lovely week on vacation, so we're happy to have him back, rested and ready to tackle what the markets are saying to him and to our team. We will provide you with a brief macro overview and address the concerns as of late. There has been a bit of volatility in the market, especially over the last week. So David will be speaking to that today. And as always, we welcome your questions. Please email me at phastings@barometercapital.ca or hit me up on the chat. And with that, I turn the conversation on this afternoon, beautiful afternoon down here in South Florida, to David Burrows. Good afternoon, David.
Pam, I wish I was in South Florida. I'm here in the new Barometer office in downtown Toronto. Happy to be in the office. Things seem to be getting a little bit more normal, and thought maybe there's a bunch of pictures that we can go through. So thanks everybody for joining us today. I'm going to try and keep it relatively brief. But here we are in the beginning of October, and as always, there's lots of questions about what is happening or what could be happening in the market, and we're going to try and read the tea leaves a little bit and get a message for what the market is telling us. As always, I just want to start with the big picture. We have had a view since 2013 that we are in a structural bull market, and while there are certainly corrections in structural bull markets, they go on a long time, 15, 18, 19 years. 2013 to 2021 makes that 8 years, which would be a very short structural bull market. And certainly we've seen corrections in 2015-16, and we certainly had a good sized correction in 2018. But a structural bull market is really 2 steps forward, 1 step back, or maybe closer to 4 steps forward, 1 step back, whereas a structural bear market like the one between 2000 and 2013 is more like 1 step forward, 1 step back. And some long drawn out bear markets. So we're going to push that around a little bit. We also have had a view that we've been going through a structural bottoming in bond yields that's been going on now over the last 3-4 years, and probably got a punctuation point in March of 2020 at the bottom of the pandemic low. We'll talk a little bit about that. And we've also had a view that we've been going through a bottoming and reversal in the long-term bear market and commodity prices. And so if you put stocks together with commodities rallying and bonds weakening, that would be a reflationary environment, which is very different than the disinflationary environment we've been in really for like the last 30 years. So important to understand that macro view because it could have a major impact on returns. What works in reflation is quite different than what works in disinflation. So let's just push this around a little bit from the high level. This is the S&P, and we go through this at the beginning of every webcast. We were in a channel really from October of last year. In fact, September, October saw, some pullback, shallow pullback, concern about whether the virus would derail the economy over the course of the winter. Then, of course, the market just surprised everyone and rallied in a pretty straight line fashion through up until August. In August, we said it's very possible as you get into September, October, as usual, you get some bumpiness. We didn't believe, based on the way the market was set up, that this would turn into something that was significant, but certainly 5 or 6% would not be unreasonable. And as it sits right now to the most recent low, the pullback in the S&P, about 5.9 or 6%. I think at the worst point yesterday, it was just about 7% for the index itself. Of course, lots of stuff going on underneath the surface that we need to push around a bit. But certainly, this is within the realm of what we've been talking about. We continue to be above a rising 150-day moving average and a rising 200-day moving average. And we have been seeing some correction. So let's move beyond there and let's look at the point and figure chart for the S&P 500. The reason I use point and figure charts is they highlight inflection points where there are reversals taking place. So this is March of 2020. We've been seeing lower highs and lower lows all through that bear market. And then something changed. We made a higher high and a higher low. And since then, higher high, higher low, higher high, higher low, higher high, higher low. You get the picture. And that has it got continued on unabated. So at this point, no change in trend for the S&P, rising long-term moving averages, a very constructive point and figure price chart. Certainly, we have to look at what is happening sector by sector underneath the surface to understand whether things are deteriorating or strengthening. But at this point, at the index level, things continue to look okay. From the bond market's perspective, we made the case that we saw a generational low in yields, or a high in the long-term and the long end of the bond market in February, March of 2020. We saw continued lower highs. And then, of course, from May of this year, April of this year, we saw some correction in that trend. And our belief was this was more correction than anything else. You don't go in a straight line. In fact, the bonds retraced about 38% of the decline that took place from March of 2020. So about a third, which would be very typical. You can see that the longer term moving averages continue to work their way lower. And then recently, over the last 10 days, after trying a couple of times to get through this high at $152, failed, and the bonds started to sell off again. So I think there's an important message there. We're going to talk about it, but just to jump ahead, for those who believe that we are headed into some kind of a slowdown due to the Delta variant, or running up against the debt ceiling in the US, or the Evergrande situation in China, or just the fact that the cycle has been going on for a while, this really shouldn't be happening. You should see bond prices going higher. If you think we're slowing down, that would mean yields lower. So we'll talk about that a little bit. There's the 10-year bond yield, the point and figure chart. This was the high, early 2020, lower highs, lower lows, consistently until the 5th month, May of this year, where we got a little reversal. And we rallied up into this downtrend line, where ultimately, over the last month and a half, we broke to a lower low, failed to make a new high, made a lower low, and we are back in a downtrend in the US bond market, or a trend higher in yields. When we look at the 10-year as to what might be happening, we know that as we blasted off in the stock market, the economic data really improved. And then for a number of months, we've seen weakening economic data, or underwhelming the expectations. But you can see here that really since the end of August, the economic surprise data started to turn higher. And that's right around the time when bonds started to sniff out the fact that maybe this slowdown in data was starting to abate, and bond yields started to go higher. So I think that that's an important message to take away. We're going to talk a little bit more about that. When we get to commodities, clearly a really important tell on the economy. We know that energy prices, of course, are in the news, natural gas and oil prices around the world working their way higher. What we're looking at here, though, is a broad base of commodities, inputs that go into the manufacturing process or our everyday life. They include agricultural commodities, they include energy, they include metals. This is an equally weighted basket of all major commodities, including things like rice and rubber. But you can see that after consolidating through June, July, and August, we made the point of a few weeks ago, it looked like these were starting to reaccelerate. And again, commodity prices have been accelerating now over the last month and a half. So certainly what I could say from the big picture is we've seen some consolidation in stocks. We saw some consolidation in commodities, both of which look to be, well, certainly the commodities look like they're running their course. The fixed income picture looks like it's running its course. We're going to delve underneath the surface. But this is the long-term picture of the RJI, or Rogers Commodities Index. And it certainly broke the long-term trend that went all the way back to the beginning of the bear market in 2008, and is now trading above a rising, very long-term 200-week moving average. That is substantial. So we talked about a month ago about the fact that as we move into September, we move into a choppier period historically. Since 1950, if we indexed all of those years over the years, this is kind of the seasonal choppiness that we tend to see over the next 30 days, which works into about the middle of October. Now, clearly some years, which we can all remember, a lot worse, some years better. But the fact is, generally, there is a little bit of volatility. So what are the key concerns that we keep hearing about? One of the things, obviously, is the Delta variant, which Over the last 2 weeks in the US, the cases and the hospitalizations have started to roll over. Evergrande, the Chinese real estate company's apparent default on a very significant amount of debt is a concern. Could that be sort of a Lehman moment that could wash through financial markets? The seasonality that we just talked about, we've all heard about supply chain disruptions and some of the challenges for businesses, and the fact that auto producers are producing and selling significantly fewer cars than they would otherwise do if they weren't disrupted. We hear about the debt ceiling and all of the problems that that could bring. So there's lots of things to worry about. Now, I do like to say to people, we spend about 20% of our time thinking about what could possibly happen, but more importantly, spend about 80% of our time trying to figure out what is happening, right? Markets are pretty efficient over time. They recognize change generally before it's obvious. And all of the tools that we have are aimed at doing that. We think that ultimately, to be successful, you really have to understand what the market is telling you. So focus less on what we think should happen. And there's lots of folks that would tell us why it is the market should be lower, and frankly have been for the last 16 months. And spend more time trying to understand what is happening. And does it make sense given what we think we know? Okay, so let's just do a quick review on some of the leadership themes and things that we've been talking about. At the index level, they have all pulled back off highs. S&P about 6%, NASDAQ 100 at the close yesterday was about 7%. Frankly, on the lows yesterday was about 9%. The Russell 2000 about 11%. We talked about a month ago about the fact that the average stock under the surface was correcting more. And so the question is, does the average stock continue to correct more than the indices? Or do the indices start to underperform some of the average stocks? And we want to talk a little bit about that. We put up on the screen in the beginning of September the fact that despite we had seen some consolidation in the more cyclical themes, and despite concerns about economic strength, we were seeing something interesting. High beta stocks versus low beta stocks had turned and started to outperform. Consumer discretionary versus consumer staple, offense versus defense, had started to improve. And transports versus utilities, again, had started to improve. Now, if we think we're going into a slowdown, this is not what should be taking place. This is one of the reasons we felt that whatever pullback would come in September, October would likely be fairly muted. So let's talk about that. We also talked about the fact that the largest stocks in the NASDAQ were likely masking the weakness under the surface. So the NASDAQ 100 had seen very extreme flows in, I think, investors looking for secular growth, predictable growth, if they had concerns about economic strength. And so those very strong large cap growth stocks masked perhaps what was happening under the surface. And that maybe it was true that we had actually been seeing some correction in the market since May. So corrections come two ways. They come in price by price falling, or they come in time by stocks consolidating sideways and not making progress. And we talked about the fact that industrials and some basic materials companies and some financials had chopped their way sideways through the course of the summer, and that tech was sort of carrying the day. Our view was that likely we would see a reacceleration in the cyclicals, and that we should have a baseline of technology because it continued to be leadership in the market. And I think most of you know we had an underweight in technology because we did feel there's some risk there, but we did have a weight in the cyclicals. So if the cycle is slowing or failing, these are the things that would make sense to have happen. The defensive sectors are bond proxies, things that act like bonds. If bonds were to rally, then defensive sectors should also rally. Things that are predictable, utilities, staples, and telcos. Secular growth stocks should rally, things that have predictable growth attached, not so attached to the economy. Large companies, a little safer than small companies, should outperform, and cyclicals should do poorly. So let's ask the question, is this what's happening? Has the market sentiment changed? Has the picture changed? And should the portfolios change? So first of all, let's take a look at the long end of the US bond market. After rallying in June and July, stopped making advances. And in fact, in the last 2.5 weeks, have started to fall in price. That's interest rates going higher, bond prices moving lower. Certainly no move to defense here. When we take a look at utilities in the last 4 weeks, certainly no rush into utilities looking for safety, and no relative performance versus the S&P. Let's look at the NASDAQ 100, predictable growth. Certainly performed well up to the end of August, but September, October, actually, we know underperforming the S&P, and on a relative basis, beginning to underperform on a longer term basis. Let's look at offense. Equally weighted financials. So every company in the sector worth the same, certainly consolidated from April through until the late part of summer. We saw low, higher low, now about to make higher highs, and relative strength versus the S&P rising since the end of June. So if we think we're slowing down, or if we think Evergrande is a problem, you would expect the equity prices in financials, which are tied to the economy and interest rates, would start to weaken. But in fact, that's not the case. They've been strengthening over the last 4 weeks. Energy, again, a great input that goes into the economy. Demand is important here. Supply demand move much higher in relative strength versus the S&P. In fact, energy now having its best year in 20 years. And that's certainly supported by moves higher in oil prices, which just broke above the highs that we got to before we started to consolidate in early summer. And of course, we know that natural gas prices have blasted off around the world. So certainly it could be just a supply issue, but certainly supply and demand are both important. So financials strengthening on a relative basis, energy strengthening on a relative basis, commodities as a whole strengthening on a relative basis. In fact, while the market's been selling off, commodities have been moving higher. And now let's look at another defensive group, the consumer staples group, selling off actually a fair bit more than the stock market over the last 2 weeks, relative strength underperforming. On the other side, consumer discretionary, leisure and entertainment and travel on the last 6 weeks, relatively outperforming and looking as though it's beginning a new leg higher. So if you think that we're headed into a more difficult period, and if investors around the world are repositioning for that, you would expect defensive sectors to outperform. Let's break the world up into 3 periods so far this year. And this came from Strategas, one of our research partners in New York. I like their work. They took the period of December through March when yields were going higher. And you would expect if yields are going higher and bond prices are moving lower, bond proxies should probably underperform. And of course they did. They underperformed, negative returns versus financials with a positive return. Then we had the period where yields corrected. Yields pulled back, bonds had a little bounce. And while they outperformed financials, they outperformed by 0.8 of 1%, but really made no relative gains when they should have. And then, of course, we're back since August the 4th. Yields are moving higher again, and consumer staples and utilities underperform. So defense clearly underperforming all year long. No sign that investors are changing their spots. So this can go on for a while. Now, we know that money came out of cyclical sectors between April and August, but certainly flows have started to reverse. Why is that important? When we get down to these levels, generally corrections are pretty close to done. And once they reverse, flows reverse, they can reverse for a long time. My guess is the cyclical and more economically sensitive sectors are telling us that perhaps the growth scare is over and priced in. Perhaps the Evergrande situation in China is something later in an economic correction than at the beginning of an economic correction. Financials, after having flows come out from April through August, financial flows again have reversed, consistent with what happens in other corrections. And the NASDAQ 100, after significant flows in, have started to see flows come out, but by no means have they been overdone to the downside. So if you had to make a guess, it's possible that if people believe the economic cycle could reaccelerate in the fourth quarter, then it's possible that the big technology stocks could underperform relative to the under-owned reflationary sectors, which are more short cycle versus long duration assets in the growth stocks. So defensive stocks underperforming, predictable growth stocks underperforming, economically sensitive stocks outperforming, not just this week or today, but really since about the middle of August. So let's just touch on one other risk asset, which we talked a little bit about and had questions about. Bitcoin, after rallying off the lows in July, pulled back through September. In the last week and a half, has blasted off again to the upside. Same with Ether, again, more risk-oriented assets. So we always have to read the tea leaves and try and understand where money is going to and where money is coming from. We know that during falling interest rates over the last number of years, people have found solace in high dividend paying defensive stocks and secular growth stocks. Underowned and very small, much smaller parts of the market, energy, financials, industrials, underowned, relatively unloved, and did poorly over the last number of years. I think that we're seeing a sea change that began last fall. So we have to look at the world through the lens that we look through. Our job isn't to be everywhere, but it's to focus in areas of market leadership without any bias, to recognize change as it takes place and constantly be moving towards the places money is going to, and be prepared to move away from groups, whether they're well-loved or not, when we see money start to flow away. It is a tactical approach, and I think it's really important in a market where it's dominated by very expensive defensive stocks and very expensive growth stocks that are owned by everyone. When things start to change, they could change for a long time. So just to look at our exposures, again, by far, our biggest weight continues to be financials, and we have continued to top these up. These include insurance companies, money center banks, regional banks, Canadian banks, and asset managers and capital markets companies like Morgan Stanley. All of them benefit in a rising rate environment where the economy is strengthening. And on a relative basis, really nicely outperforming over the last few weeks, looking like we're into a new leg higher. Technology, which we have had an underweight position in over the last several months, has become a smaller weight, roughly half index weight. It's not our job to say that the market's wrong or that they're great companies. They are, but they're well-owned and perhaps expensive. Energy is a significant overweight in the portfolio. We are a little more tilted to natural gas than oil. The companies like Canadian Natural Resources on the oil side, Tourmaline on the gas side, certainly are great contributors to the portfolio. When we go down the list, consumer staples, a relatively small part of the portfolio, utilities, a relatively small part of the portfolio, and defensive sector like healthcare, relatively small part of the portfolio. So we continue to be bullish, and we watch every day for signs that our leadership groups are breaking down. And at the security level, of course, we use our stop losses. If individual securities aren't able to continue to hold up technically and start to behave in a way that doesn't make sense, given what we think we know, we're very happy to go to the sidelines. And you can see that we've been doing that on some of our technology positions. So just to kind of circle back, the S&P has rallied sharply since last fall. Likely the August period, July-August period, was driven by technology gains. And then ultimately, technology stocks have kind of rolled over and started to weaken. In fact, the index now is acting weaker than the average stock. Yesterday, when the market was down 1.4% on the S&P, the equally weighted S&P was down 0.6 of 1%, roughly half. The weakness in breadth was in the sectors that we've talked about, technology and defensives. And breadth improvement took place in things like financials and commodities and some industrials. One of the things I watch for in a correction is what happens to volatility. We had a move higher in volatility in the early part of September to September 20th. The S&P made a low. It rallied, made a lower low, but when it did, volatility failed to make a new high. To me, that's a divergence. Volatility not telling us we're heading lower. And here we are today, volatility moving back lower again. So volatility diverging. Let's talk about credit. Credit markets are not showing any sign of concern about Evergrande. In fact, investment grade and high yield bonds, credit spreads have narrowed over the last week, meaning that bond investors are less concerned about default rather than more. And that's the case for corporate credit around the world outside of China. So it looks like Evergrande is relatively muted at this point as a global driver for markets. So understanding that we've seen both price correction in the average stock and time correction in some of our leadership sectors, I think that we're getting later on in this correction. Last couple of points. On September the 20th, 63% of stocks made a 20-day low. When the market made the next two lows, fewer stocks made a new low, and yesterday, fewer stocks made a new low. Internal divergence, the average stock getting better. So I think that the bonds yields rallying is telling us that the market is anticipating economic data to reaccelerate, and that's how we're positioned. Of course, we watch every day for signs that we're wrong. We'll use our stops in all of our positions. I got asked today, what would cause us to get more defensive? Well, frankly, if our main themes started to fail, or if individual positions started to break our stop losses, both would cause us to reposition, as we have been taking down weighting in technology. But cyclicals versus defensive after correcting are reaccelerating. The 10-year yield is reaccelerating. We think we're setting up for a very strong fourth quarter. And the last thing I'll leave you with is this. Historically speaking, and we know that historically speaking often doesn't matter much, October, November, and December offer very strong outperformance for industrials and cyclicals. And we're through September into October, and it looks like we are seeing that acceleration. Now, we will get defensive if things start to change. We've shown a willingness to do that in the past, but as it sits right now, we continue to be quite optimistic about the fourth quarter. We worry every day about the things that are in the press, but unless the market starts to care, it means that there are other positives offsetting the negatives. There's lots of liquidity in the market and likely to continue to be for some time. And there's lots of cash on the sidelines. We continue to be pretty fully invested. And with that, Pam, if there are any questions, certainly happy to answer them.
Thanks so much, Dave. We touched briefly on signals identifying change and what we would do when we look at being defensive with our portfolios. What major signals are you looking at when we start to become more defensive?
Well, as we just talked about, we look at our sector exposures and what's happening in it from a sector perspective. If relative strength in our groups or breadth in our groups starts to deteriorate sharply, then first of all, we put no new money to work. The example would be technology. We're seeing some deterioration there. Our individual positions are hitting some stop losses. We've gone from an underweight to a half weight versus the market, and that's reduced our exposure there. On the other hand, financials are improving. And actually, as of today, making a new relative high versus the S&P for the year, we're adding there. When we look at things like some of the basic materials in our macro fund, very significant exposure to basic materials because they are improving and making new relative highs versus the market. And you can see on a day yesterday where the NASDAQ was down 2.5%, I think the macro portfolio is off about 60 basis points. Today, it's up close to 3% on a day where the market's up 1.5%. So we take it theme by theme. And as it stands right now, the index itself is in a confirmed uptrend. So that is supportive. Our sector themes are supportive. Securities trading above our stop losses. All three of those things could cause us to change our stance.
Thanks so much, Dave. Thoughts on railway companies? Should they not lead if the economy starts to show signs of improvement? What are your thoughts there?
Certainly the railways are interesting, but we need to see them start to show us some improvements. So let me just see if I can share my screen for a moment. So the transports as a group, have corrected since the beginning of May. They rallied a little bit along the 150-day moving average and then failed. So we took a bunch of exposure out. Now, the dry bulk shipping index, which is dry bulk shipping in ships like coal or grain, those prices have been rising and some of the dry bulk shippers are performing well. The container prices have been moving higher, but the transports as a whole, I think, are still languishing because of concerns around bottlenecks in the supply chain. I think ultimately the rails should perform well, but that doesn't cause us to add positions until they start to perform. You can see CP. We take a look at CNI. It certainly looks better because it broke out when CP won the Kansas City Southern deal. It looks like it's making a nice turn here to get more interesting, but they're all different. There's CSX starting to make a bit of a turn. So you can see on a relative basis, since the 20th of September, while the S&P has been weakening, it started to strengthen. So something going on here for the rails and likely something to do. But at this point, there have been other things for us to focus on.
Thanks so much, Dave. Lightspeed Commerce Stock. It's a common name that certainly Barometer, it was a favorite of Barometer's. If you could just walk our investors and prospective investors through how we would interpret any of this short selling accusations, the short selling accusations on and any news. How would we look at that? How do we think?
I think you've always got to remember this. 70% of the way a stock moves is driven by market itself and sector exposure, right? 20 to 30% is specific to the individual business characteristics of the underlying companies. So I put up on the screen iPay, which is an ETF made up of the digital payments companies. And you can see that they consolidated sort of from February through until September. Now, since the early part of September, over the last month, the group is considerably backing off. Now, this coincides with an acceleration within financials, but within the banks and the investment banks and the asset managers. So, investors position themselves within sectors based on what they believe. And I think that Lightspeed is a wonderful company. I think that Visa is a wonderful company. I think Shopify is a wonderful company. I think Square is a wonderful company. But as we're seeing acceleration in companies like Morgan Stanley and JP Morgan and showing improvement in these groups, I think that maybe money is rotating. So this is the move higher in JP Morgan, Silicon Valley Bank Corp. All of these things, we're seeing really nice moves. And I think that it's just money rotating. I wouldn't put a whole lot of stock in, the short seller concerns right now. I don't think that that's what this is about. I think we're seeing some money leave secular growth stocks in the short run and moving into more cyclical stocks. So banks and asset managers and capital markets versus digital payments. It's not to say that it isn't a wonderful company. It's a great company. But certainly, hold on, sorry. Why is it not coming up? Sorry. We're pulling back to trend. And I know it's painful to see a stock pull back like that, but we've got a rising 200-day moving average, a rising 150-day moving average, and we've pulled back basically into this breakout point here. See if I can highlight it. So you probably can see some support in here. But I will say that it is likely if tech continues to underperform, we will start to, we moved from 28% in tech. We're down to sort of 15% in tech. And we've been just ramping up some other sectors. I think that there's some correction taking place here as a group.
Thanks so much, David. Well, that concludes the questions we've received for this afternoon session. I'll leave you, as always, with the final word.
Yeah, look, I think that when you have the kind of takeoff or thrust that we saw in the early spring of 2020, and they are very rare, they tend to be the beginning of a new cyclical bull market. And cyclical bull markets have interruptions, but when you get that kind of thrust, you don't tend to have deep corrections, especially when there is as much firepower left sitting on the sidelines. People are shaken out of positions, money and money market funds and so on. There is a mentality that's been built in to buy the dip, and that should be helpful to people who have, significant tech weightings. But on the other side, the cyclical sectors continue to be way under-owned. They're very inexpensive relative to other groups. I look at a company like Ford. Ford is a company that is not well loved, but it's cheap, cheap, cheap. And, they are going to be right in the mix with electric vehicles. And certainly Ford pulled back from kind of June through until the beginning of August, but against a weak market, now reaccelerating to the upside. I think that's an example of the type of company people are rotating into. Companies like Nutrien, in the agriculture space, right? What bear market, So there are pockets of strength, and we want to focus in the pockets of strength. We want to listen to the message of the market. And I would just say this: if the cyclical groups, commodities, financials, some industrials, some energy, are accelerating, it is unlikely that the market is making a big bet on an economic slowdown. So thanks very much for joining us, everyone. Hopefully it's useful. Happy to answer questions outside of these calls. Don't hesitate to give me a call or give one of your investment counselors a call if you think you benefit from a conversation with us. Please don't hesitate to reach out. Our business is half of it is managing money, and half of it is taking care of individual clients, and hopefully we do a good job with both. So thanks very much, Pam.
Thanks so much, Dave. Have a great evening.